Welcome to the very first chapter, which is the financial management function. So, we'll be running through the financial management function, looking at the nature and purpose of financial management, the interrelation of financial management, financial accounting, and management accounting, stakeholders, objective, and agency theory. So let's look at the nature and purpose of financial management. Financial management refers to the aspect of management that involves planning, controlling the financial affairs of an organization to ensure that the organization achieve its objective. So it involves decision about how much finance does the business need for its daily operation, where the finance should be obtained from, how to manage short-term cash, and how much should be paid as dividends. So, and how to also protect the organization against financial risk. So when you hear financial management, think of it as you are planning the financial, everything that has to do with money. You are planning how to raise the money, how to manage the money for short-term purpose, for long-term purpose, how to get the money, how to decide how much you are paying as dividend and how much you are retaining, and how to overall protect the organization from financial risks. So what is the interrelation between financial management, management accounting, and financial accounting? Financial accounting is concerned with the preparation of financial statement. We all know that, and it's about using historical data to prepare what we have now or compare with what we have now, and is majorly focused on external financial reporting, external users, external, both internal and external, but majorly external. Then management accounting is concerned with giving management information for them to make decision, how to plan, giving them information to plan their resources, giving them information to manage and control their resources, and it is usually what's internal reporting. Then for financial management itself, it is focused on how an organization manage their finances, raise finance, and use them efficiently and effectively. And it is concerned with what raising of finance and effective allocation of resources. Its focus is on what both internal and external users. So now, what is their relationship? We've seen their differences. Now, what is their relationship? One, the ratio analysis you get from your financial reporting, we're talking about your EPS, your DPS, all investor ratios are used to make decisions in financial management. That's what you use to advise your investors, or what your investors see and they are willing to what invest in your organization. These ratios are gotten from financial reporting. Then the budgeting process, management account is where you prepare your budget, where you talk about your flexible budget, your fixed budget, zero base, any type of budget, your sales budget, your production budget. Management account is the guy that prepare what budget. So, and without this budget, you might not be able to make in strategic planning. You might not be able to plan. You will not know how much you are working towards raising for financial management function. So also another point is your long-term investment appraiser. You see that both in management accounting and in you see that both in management accounting and also in financial management. So then for management accounting, it provides information on working capital, the components on working capital. Then financial management, while financial reporting, which is the financial accounting, gives you what you are owing, gives you the state of your working capital. How much are we owing account receivable? How much are we owing account payable? How much should we expect from our customers as account receivable? But financial management is concerned with managing that money you already have, managing the working capital you already have. So what is fine? We have financial objective as another section. What is financial objective? What this one is just trying to say is that every organization has an objective, and they have strategy to achieve that objective. Your objective is your target, while the strategy is how you will achieve the objective of that organization. And we've said over that the objective of a company is to maximize the wealth of the company's what shareholder, is equity shareholder. That is the main objective of any organization. Then for the state-owned organization, they are looking at how to provide standard quality public service, while charity organization is looking at how to satisfy a particular group of people. So Every financial objective that you are setting must be specific, measurable, it must be achievable, it must be relevant, and it must be time bound. That is the SMART goal. And it must, you have to accomplish it through financial management. So, somebody will say sometimes not every organization is looking to achieve a financial objective. Yes, that's correct. For example, the government is not looking to achieve a financial objective, but we always have a financial constraint. So it's either you have a financial objective or you have a financial constraint. That is the reason and essence of financial management. So let's move to strategic process. How do we come up with strategy to achieve our financial objective? We have 5 major steps. One, you want to identify what the objective is. What objective are we trying to work towards? Identify it. Is it a financial objective? Is it a financial constraint? You want to identify your corporate objective. The next thing, you want to set target for the financial objective. How do we meet this objective, or when do we want to achieve this objective? Is it in the next 6 months? Is it in the next 3 months? When exactly do we want to achieve this objective? Then after that, you want to develop strategy for achieving the financial objective. You want to develop strategy for achieving the financial objective. Then after that, you want to convert these strategies that you have developed, you want to convert them into actionable plans, your day-to-day activities. What will it look like if you are working towards achieving a particular objective? Then after that, you want to monitor performance, monitoring the performance. Then this implies that the identification of a primary objective is the starting point for the formulation of a strategy to achieve the objective. The first thing you want to do is to identify what your primary objective is. Then how do we identify this primary objective? Let's look at it. We have 4 ways in which we can express financial objective. For you to say our financial objective has been met, we have 4 major ways. One, we can look at it through stakeholder value creation. Two, we can look at it through shareholder wealth maximization. Three, we can look at it through profit maximization. And four, we can look at it through earnings per share growth. Don't forget that the fundamental principle of financial management is shareholder wealth maximization. However, there could be other financial objectives, which are these other 3 that we have. So let's start with stakeholder value creation as a financial objective. It refers to creating value for all your stakeholders. When we are talking about your stakeholder, we're talking about your customer, your supplier, your employee, your government, trade union. You're talking about your lenders, and so on and so forth. So you could have your internal stakeholder and your external stakeholder. How do you create value for them? You want to make sure that you are meeting their objective. Each of the stakeholder has their own objective. They have their needs. You are making sure that you are balancing their needs with that of the organization. You are making sure that there is no conflict of interest between the various group of stakeholders. So that's what we are looking at there. What is the advantage of taking this as a financial objective goal? Number one, when you have your stakeholder value creation at heart, you have a good reputation. You have a good reputation. People are impressed. They have positive experience with you. Then another one is to create stronger bond. It helps you to create stronger bond, and this stronger bond will lead to loyalty. That's when you have returned customers. You have people that want to do business with your organization. You have contractors that are willing to work with you. You have people that are ready to give you their funds for you to use to run your business. Then another thing is it gives you a competitive advantage because you carry your stakeholders on your head. Unlike your competitors, you have a competitive advantage. You have a strategy differentiation. It is clear that these people have our interests at heart. Then people want to do business with you. Then another thing is long-term sustainable growth. Because of your investment in human capital, you have good employees, you have innovation, you are responsible socially, you are doing things for the environment, you are not polluting the environment, you have tendency towards to have long-term sustained growth. Then another thing is it can improve risk management because you have been proactive, you have satisfied your customer well, you don't have issues with anybody, nobody is suing you, are not suing anybody, you are paying your debt on time and all of that. It will lead to what? Improve risk management. There will be lower risks for the organization. So what are the challenges? Let's look at the challenges. How do you manage conflict of interest between the various groups that we've mentioned? How do you identify the metrics to say, okay, yeah, we've actually achieved stakeholder value creation? That's another challenge. How do you even distribute power between the stakeholders by not, putting everybody in a balanced state, putting them and making sure that one does not have too much power over another? Then how do you address global issues that affect them? How do you manage trade-off between financial and non-financial objective of stakeholder? How do you how do you how do you ensure that you integrate this stakeholder value creation into the organization objective, the organization culture, the organization operation? How do we ensure that it's reflecting in every of our day-to-day activities? The another objective is the shareholder wealth maximization, and we already know that it means maximizing the value of your shares, of the shares of the owners of the company. You maximizing their wealth either by paying them more dividend or by increasing their share price. Then, what are the advantages of shareholders wealth maximization? Clear objective of the organization, efficient allocation of resources, ensure long-term viability, ensure that the organization is responsive to market demands, and support long-term growth and sustainability. Then challenges. What challenges can we face? How do we measure it? What period do we give for wealth maximization? When do we say that we've achieved wealth maximization? How can we divide the wealth maximization into targets for dividend payments and targets for shareholder price? And sometimes we know that share prices are not affected by performance of the company, they are affected by sentiment. People already know that, okay, the price of sugar is going down this week, the price of petrol is going. If I have investments in that area, I'm going to withdraw my funds. So all oftentimes it's not just about the company itself, it's about the reaction of investors to news and all other things. So it can affect the share price. So another objective is also profit maximization as a financial objective. This one is talking about, making profit, having the highest profits that you can actually think of. Increasing your revenue. It can be done by either increasing your revenue, reducing cost, efficient allocation of resources. So what are the advantages? It is clear, it is simple. When profit increase, we know we've achieved that objective. Also, it helps the organization to reduce costs, manage money, manage your resources, manage your capital, so that you can maximize what profit. Then it is easy to understand and measure. Anybody that sees profit of last year and there's an increase in this year, you automatically know what that means. You don't need anybody to interpret that for you. Then it's encourage a culture of competitiveness. People are always coming up with improved processes, improved ways of doing things, and that way you have um there will be innovation. That way there is competitiveness. You are doing better than your competitors and all of that. Then it increase returns to shareholders, to dividend payments and capital appreciation. Yeah, when your profit increase, it means that there's more profit available for shareholders to take home as dividend. And maybe in the long run, when the profit is reinvested, your capital can also increase. But what are the challenges? How do we decide the period in which profit will be measured? How do we raise how do we raise more capital that can be invested to make more profit? That's another problem. Then how do we encourage short-term investment or focus by the managers, partly because their remuneration, sorry, this one says that it can be a problem because managers are now working towards making profits in the short run without even looking at what happens. They just want to meet up with their performance targets and all of that because they know that their remuneration is based on it. Another thing is that the shareholders are looking at cash flow, but you are looking at profits. So that's another problem. Then it can lead to window dressing. They want to adjust what profit that has not been made. They are already counting it as profit. They are reducing their expenses and overcasting their revenue, just manipulating things to just make sure that profit looks good. Then earnings per share growth. Earnings per share is also related to profit somewhat because this is what the investors look at to say, okay, let me invest in your company. So it is is a way of measuring your profit per share. Like for each share that you have in the company, how much does my share worth, for how much profit am I making on each share that I have in the company? How much profit am I making on each share I have in the organization? So how do we calculate it? It is profit after tax and preference dividend divided by the number of shares in issue. And what is the advantage? EPS ensure that there will be more profits to pay the dividend per share. It ensures that there will be more retained profit to reinvest. If you want to reinvest, if you don't want to share as dividend, it's just showing us that, okay, yes, this company has potential, they have money to invest in the future, to get more money in the future. Then it results in growth of shareholders wealth over a period of time. So if you have invested your money, you know that definitely in 5 years time, in 3 years time, in 10 years time, money is coming back to the organization. But what are the challenges? It can be increased through borrowing and debt capital, and not by the performance of the company. So sometimes when we see profits, go and check the borrowings of that company. It could be that that profit is not an actual profit. That profit will be used to pay debts in the future, because they have debts that will be maturing very soon and all of that. So it can be financed through debt. And when you have debt, which will lead to what? Financial gearing, because you are now exposed to more risks, because you have debt all over the place, and that in the long run will also affect your share price. So it's also a measure of profitability, but it's subject to the same challenges that profits that we've discussed about profit maximization. So what are the main points under this company's financial objective? We are looking at financial management. When we talk about financial management, we're looking at the investing decision, the finances decision, and the dividend decision. We are also looking at it from the part that it relates to from the part that it relates to financial accounting and management accounting. Also, the main objective of financial management is to maximize shareholders' wealth, and all we've also talked about the challenges that you will face when you are trying to maximize shareholders' wealth. Financial performance is therefore evaluated in a number of ways: by increase in share price, growth in profit, and growth in EPS, and so on. So now let's look at the stakeholders. Stakeholders and their objective. You have, who are stakeholders? They are anybody, and it could be anybody that is interested in the activities or performance of your organization. And we have a lot of them. We have the shareholders, we have directors, we have other employees, we have lenders, we have the government, we have customer, we have supplier, we have the society. Everybody with their own interests. So who are the shareholders? What are they looking for? Shareholders are the people that have invested their money in the business of the company. And what are they looking for? They are not looking for what other stakeholders are looking for. They are looking for profits, they are looking for dividend, they are looking for growth in their investment. Then for directors and senior managers, what are they looking for? These are the board of directors, these are the senior executive management. Think of your CEO, think of your CFO, think of the C executive guys. Those are the guys there. And what are they looking for? They are looking to advance their career. They are looking for more money, more income, good working condition, and personal wealth. Then other employees, what are they looking for? Stability of their job. They are looking for salary. They are looking for, can I grow in this organization? Can I stay here in the next 10 years and become, from intern, become a CFO? So that's what other employees are looking for. Is it that you can just lay me off? What's the job security in this place? What is it like? So that's what they are also looking out for. Then lenders. When a company borrow money, the lenders are now stakeholders. It can be banks, can be investors in bonds. They are looking for protecting their investments. Yes, hope this company is not going to go bankrupt anytime soon. Can they pay their debts? Can they finance their interest? This is what they are looking for. Hope they are not going to 200 other places to borrow money. How many more places are they borrowing from? Are they able to service all the debt at the same time? So that's what the lenders are looking for. Then for the government, they are interested in your tax, they are interested in regulating your business, they are interested in ensuring that the company can also supply them if they need anything from the company. If they are major suppliers to the government too. They are also looking at the economic aim. Is this company able to provide Are they able to provide full employment? Are they achieving full employment? Is it that they are fully employed, like they have people that are gainfully employed in this company? So just regulating the economy, ensuring that they are getting tax from you and all of that. So customers, what is their interest? You already know when you are buying something from an organization, you are expecting that they are giving you quality goods or quality services. Then supplier, major suppliers to a company might have influence over their actions. Think of monopoly, think of people that their industry is just them, and they have influence on their buyers and all of that. Then society as a whole, what's human rights looking like for you as a company? Are you preserving your environment? Hope there's no pollution. What's the reputation of the company in the society? So they are looking at all of this when it comes to society as a stakeholder. So let's just go to conflict between different stakeholder objectives. We've stated this stakeholder, they could they could fight at some point. They could their interests could clash, not them fighting though. So their interests could clash at some point. How do we fix it? How do we ensure that everybody is good and fine? So the major problem for for shareholders and management is that they have agency conflict. Agency conflict arise when one party is not acting in the best interest of the other party. In this case, the shareholders is the principal, while the management is the agent. So agency theory was developed by Jessen and Merkley in 1976, who defined agency relationship as a form of contract between a company's owner and its manager, where the owners appoint the agents to manage company on their behalf. As part of this arrangement, the owners must delegate decision-making authority to the management. So the owners are expected to act in the best interest of the owner. However, it is impossible to arrange the perfect contract because decisions by managers affect their own personal interests as well as the interests of the owners. So you have to ensure that you manage agency conflict. And how do they even arise? Before we can talk about how to manage them, we have moral hazard, effort level, earnings retention, risk aversion, time horizon. So let's look at moral hazard. Moral hazard is an a manager has an interest in receiving benefit from his position as a manager. If I'm a manager in your company, I'm expected to have a company car, lunch, attendance to sponsored events, and all of that. So the work of the work of you as a shareholder is to make sure you provide all of this for your manager so that they act in your best interest. But most times, most shareholders want to invest their money in high risk projects so that they can get high return, but managers are scared. They don't want to take risks because they want to protect their work. They want to ensure that their salary they are seeing every month, they are still getting it. And if it goes south, they are not blamed for decisions that are being made. So they want to just play safe and just do what they feel is safe for the organization. Then time horizon. Shareholders are more concerned about long-term financial objective, financial prospect of the company, but managers are concerned with profits based, performance based profit. They want to make their bonus now. They want to collect their salary, want to collect their bonus. They want to, meet up with their target and everything. Then now, how do we reduce this problem? How do we ensure that um this agency conflict is reduced between managers and shareholders? Number one, you look at the cost of monitoring. How do we monitor them? You monitor them by preparation of financial statements and by auditing them. And this have a cost. That's what we call the cost of monitoring. Then opportunity cost. Sometimes they will not always take, managers will not take decisions that are in the best interest of the shareholder. So that's also another cost for them. It's the opportunity cost, the cost that will be incurred if managers take decisions that are in the best interest of the shareholders. So they gave an example of a management might want to acquire new subsidiary, and they will pay more than the subsidiary is actually worth. But shareholders, it will be a cost to them because the share price will fall. But for directors or the managers, they are just concerned about what they will gain. Maybe they will now become group managers, group director, group this, group that, group CFO, and all of that. So that's what it looks like. Then the third aspect of agency cost is the bonding cost. If I don't want all of this to happen, what can I do? You are looking at the remuneration package, you are looking at the cost that is to be incurred for them to reduce agency problem, giving them shares in the company, making them feel like they are part of the company so that they can work to meet every of your interest as a shareholder. They can work to meet financial targets. So that's what that is talking about. So this is just further emphasizing what we've been talking about, reducing the agency problem, giving them remuneration package, having an independent board, having an independent non-executive board that have no executive role in the company. They are not full-time employees. They are just there to act as best to act in the best interest of the shareholders. So you want to get people like that on your board of director. They are called the independent non-executive director. They are in charge of deciding what remuneration package should look like. So you can also have the audit committee. You see them when you go through this pack. You see them. You can have audit committee. You can have remuneration committee. Just having different committee to ensure that everybody is working in the best interest of the shareholders. You can give them share awards so that they can do better. Give those executive director, giving them shares, giving them share options that, okay, oh, hold this share. You'll be able to become you'll be able to activate the share after a particular period of time, but based on a fixed price. So what are the regulatory requirements of achieving shareholders objective? That's the corporate governance angle, looking at how a company should be managed on behalf of its owners by the board of director. Now, what are the elements? The board of director, their responsibilities, their composition, the remuneration of the director, internal control and risk management, external auditor, financial reporting and independence, and communication between the company and the shareholder, and the rights and responsibility of the shareholder. What are the steps taken by corporate governance to reduce agency problem? Stating clearly the board responsibility. When everything is clear, everybody know when you are going against the interest of the shareholder. So having a strategic, you know a laid down process, the giving them how things should be done, giving them what their responsibility are, and their responsibility is majorly to ensure that decisions are taken in the interest of the shareholders. Then board composition, you want to have a chairman separate from your CEO so that the person will not be putting influence on the board. Then you should have an independent non-executive director, those people that will act in the best interest of the shareholders. They are not part of the day-to-day running of the organization, so they are in best interest of the shareholder. Then board committee, having at least three committees, like your nomination committee, those people that will appoint your directors. You have your audit committee, those people that will liaise with external auditors. Then remuneration committee, those people that will do what, that will regulate or negotiate your what, remuneration for individual directors. Then external auditors, these two, they are responsible for recommending. The audit committee will now be the one to recommend what audit fee should look like, then also review auditors performance to know whether to get a new auditor or to continue with the existing one. Then how do stock exchange help us to regulate or ensure that the company is in the is act or the owners of the interests of the owners of the company are being protected? Number one, submitting your financial statement. Publicly listed companies in Nigeria, they are expected to submit their financial statement regularly, quarterly and annual reports. You're supposed to submit all of this. Then the report should be submitted within the required time frame, or else you have to face what, penalties. So in the next part